Okay, so buongiorno a tutti. It's a great honor for me to be part of this fantastic event. And as I was expecting Eddie to focus on decision theory, which is clearly one of the big domains of achievement of IGIER, I decided to focus on what I consider to be another big achievement of IGIER, which is applied theory. I believe that one of the important contributions of IGIER has been to develop important papers in several domains of economic, fiscal policy, monetary policy, etc., you name it. So what I will do is to try and illustrate current challenges in applied theory, but on a very peculiar domain. Maristella told me that there would be students in the room. So I decided to, instead of trying to give a broad perspective in 40 minutes, I decided to focus on a very, very peculiar question and to go a little deep into a limited number of papers. And these are, of course, closer to my domain of expertise, which is application of contract theory to banking regulation. So it turns out that in the domain of banking regulation, economic theory is currently in demand by public authorities, which is a situation that I find quite unusual. And it turns out that following the subprime crisis, new forms of public interventions are being considered. New institutions are being set up to control banks and the financial system in a different manner. And regulators turn to us academics and ask us, what do we know about the theoretical foundation for such new forms of bank regulation. So more precisely, regulators claim that banks lend too much during booms and too little during recessions, and they envisage new regulatory tools aimed at dampening those credit cycles, and more specifically counter-cyclical capital requirements for banks. So my focus today will be extremely narrow. I will look at the precise question of what economic theory tells us about credit cycles and possible justifications for public intervention. And as I said, I will try to go a little deep into a very small number of papers. And in fact, I will try to analyze three theoretical mechanisms that could generate excessive credit fluctuations. One is the collateral constraint. Another is credit reversals, and the third one is pecuniary externalities. And after that, I will try to wrap up and develop some policy implications, and I will briefly conclude. So the most celebrated paper, if you Google credit cycle, you immediately find Kiyotaki and Moore, which is a very important paper that shows how small temporary productivity shock can generate large persistent fluctuations in output and asset prices. And the main mechanism here is the dual role of durable assets like land and capital, which serve both the purpose of being a production factor and also a collateral for loans. And so when borrowers are credit constrained, a negative shock can force them to sell assets, provoking a deflationary spiral. Okay? So I will go into the model to try and understand the mechanics, and then I will try to show the other alternative stories by using a very similar model and try to pin down the differences and also the common features of this model. So let me go into the basic version of Kiyotaki and Moore, in which there is no uncertainty, and there are only two goods, land, where the endowment, the total endowment is fixed, 1. The price of land is denoted QT, and there is fruit, which is perishable and which is used as a numeraire. And you have two sectors. You have farmers who have a constant productivity A, and you have gatherers who have a concave production function G. And so the basic ingredient here is that farmers are more impatient, and so they want to consume as early as possible, and they also want to leverage as much as possible in order to have more land. And the problem is that they cannot pledge their future income. They can only borrow up to the value of their assets, which is here the land holdings, but the relevant value is the discounted resale value of their assets at the next period. So the budget constraint for those farmers here is that they're going to buy some land and this is the amount of land that they're going to buy at the current price, QT. And they are going to use their income, which comes from the last period amount of land, and the productivity here is constant. There is no shock, no uncertainty. And then you have the borrowing limit. How much can you borrow to buy more land? Well, essentially the present value of the future value of the land in the date t+1. In date t+1, you will have the same amount of land that you bought today, and this will be at the future price qt+1, and you discount it by the 1 plus the interest rate. And so it means that if you rearrange term, you have a relation between the current holdings of land and the future holdings of land, which go through this number here, qt minus qt+1 over 1 plus r, which is essentially the usage cost of land, the price that you buy it minus the present value of the price at which you will sell it. And at equilibrium, of course, since capital here, land, can be used also in the other sector, the usage cost of land equals the marginal productivity in the gathering sector, which means that this number ut is also a function of the amount of land available to the other sector, to the gathering sector, which is 1 minus kt, okay? And so we have a very neat, very simple dynamics of farmers' land holding, which is given by this relation between the current income of the farmers and the future usage cost of land. And there is a unique steady state equilibrium, which is defined by this equality here, A k star equals k star times u of k star. It's unique simply because it's also equivalent to the usage cost of capital u of k star is equal to A. And since u is an increasing function, there is a unique k star that satisfies this property. Okay? So now comes the shock. Kiyotaki and Moore assume that after the economy has reached the steady state k star, there is a unique, a single, unanticipated productivity shock, once and for all, delta A at date t. And of course, this shock has an immediate impact on land price, and thus on the borrowing capacity of farmers. Not only they produce more, but the land they have is worth more, and this has an impact on their future holdings of land. Okay, so if you linearize this equation around the steady state, and if you denote by eta the elasticity of u, the usage cost of capital, you find that basically you have a first impact at date t, where the shock, productivity shock, is amplified by the change in the price of land. And then you have propagation of this shock to the future periods through the same property, but without, of course, the productivity shock at further periods. Okay? So the unanticipated shock is persistent, and it is also amplified by the change in asset prices. And in fact, this mechanism is similar to the credit multiplier effect identified by Bernanke and Gertler. But the problem is, if we remember the focus of my presentation here is on the role of bank capital regulation on lending. And so here there are no banks in this model, so obviously we have to find something else. And also there is something which is a bit more worrying, which is the fact that if you adopt more complex contracts, and if you particularly allow debt to be indexed, and I will come back to that later, those effects disappear. And finally, curiously, by the way, you realize that if you really want to have cycles, you have to add additional features. So I'll come back to that. In spite of the title of the paper, I believe that Kiyotaki and Moore is more a model of the credit multiplier than a model of credit cycle per se. But I'll come back to that later. Okay, so that's one approach. Let me go now in another route where I suggest that, after all, credit cycle may be very easy to obtain, but with a different story. And one illustration of this story is given by a very nice recent paper by Roger Meyerson, who in fact develops an alternative framework that is related to earlier contribution by Suarez and Sussman and Matsuyama, where cycles appear very naturally, and they are due to credit reversals. So how are we doing with time, Fabio?
Yeah, exactly 30 minutes.
30 minutes, so maybe I will have more time than that. So let me present a simplified version of the Meyerson model, and I'll try to show the common features with the Kiyotaki and Moore model. So here there is only one good. There is no capital. This good is grain that can be consumed or invested for the next crop. And you have farmers, but those farmers need to borrow from banks because they don't have money. And the banks, and that will be the crucial element, the banks must be given the incentives to select the farmers or the farms that have a high probability of success. Okay, so there are two types of farms, if you like. The one with a high probability of success, alpha, and others with a lower probability of success, but probably they are less costly to find for the bankers, or they could give private benefits to the bankers, so there is a moral hazard problem. Without correct incentives, the bankers would have a tendency to lend to the wrong projects. Okay? So the interesting feature is that there are overlapping generations of banks in the Meyerson's model. And in the simpler version that I'm presenting here, bankers only live 2 periods. And at the beginning of their life, they sign contracts with investors which specify the size of the bank and the payments to the banker as a function of the outcome, success or failure in the 2 periods of the short life of the banker. And for simplicity, I take the version without discounting and with universal risk neutrality. And so what do you get in this? Let me go a little deeper into the technology first. First of all, the unit yield of a good farm, the one that has a high probability of success, which in fact can be interpreted here as the equilibrium rate of return on assets of each bank, is a certain function, R of I, of the total size of the farming sector, which is also the banking sector here. So there are decreasing returns to scale at the aggregate level. If you plant more land or if the banking sector grows, the returns decrease. But at the level of each individual bank or farm, the returns are constant. And the return is obtained only with probability alpha, otherwise they get 0. And there is no aggregate risk. Okay, that's a very simple setup. And so I don't have the time to explain all the intricacy of the determination of the optimal contract, because this thing is quite robust and can be extended to infinite horizon and these kind of things. But let me just show you the very simple form of the optimal contract in the case of a 2-period model only. So the first property is that the banker is only paid if he has been successful twice. He's paid at the end in order to maximize incentives to select the good project. The banker is only paid at the end if he has been successful twice. If he's not successful at the first date, the first investment phase, the bank is liquidated. So it's really a very extreme form of incentive mechanism. And if, on the contrary, the bank succeeds at the first period, then the banker is allowed to grow the bank. That is, he is allowed to lend to more people. Okay, so this size aspect is a crucial element of the incentive scheme. The banker is not paid immediately, but is given more power or more assets to control. And since the banker is only paid at the end, incentives can only be maintained for the 2 periods if each successful bank is allowed to grow by a quite large extent, and actually by a factor which is exactly the inverse of the probability of success. Okay? So the idea is that in expectation, the profit or the benefit or the bonus of the banker should be the same. So you know that you will get it only with probability alpha, but since you grow the size by a factor 1 over alpha, the expectation is the same as before. Okay? So that's a crucial element of the optimal contract. And as I said, each banker that has succeeded twice received at the end a bonus which is proportional to the size of the bank that he controls. That's also a very important element. The bonus is equal to B times the final size of the bank. So this constant B is a measure of the intensity of moral hazard, and it also implies that the bankers want to be as grow as possible, as big as possible. Okay? So now we have to compute the equilibrium conditions. And Meyerson takes a very extreme situation where you have free entry and constant returns to scale. So it means that the net expected return on equity of a bank that is created at day t should be 0. Remember that the 0 is the riskless rate, okay? So the net expected return on the bank is of the shareholders of the bank who finance the institution has two components. First of all, at the date t, there is, or t plus 1, at the end of period t, with probability alpha, you get this amount for a unit size, for a size of 1 initially. So that's the unit return on equity here. And then in the second period, you succeed with probability alpha squared. That is, you have to have 2 successes in a row. But if you succeed, this will be on a bigger scale because you have grown by a factor 1 over alpha. And you only have to pay a bonus B to the banker, which means that the shareholders will only get the difference between the return on the next period and the bonus they have to pay to the banker. That's the cost associated with moral hazard, okay? So, but interestingly, the two coefficients here sort of cancel out because if you simplify this formula, what you get is that the equilibrium condition for in this model is very simple. For all t, the sum of the return on the investments of the bank should be equal to the expected bonus that will be paid to the banker, okay? So this formula is remarkable by its simplicity, but also by the fact that it gives immediately credit cycles, cycles of order 2. Why is that? Well, if you look at what will be the return in date t plus 2, obviously it will be b minus r of I t plus 1, which is also r of t. So unless you're already in a steady state, unless you are at a point I star where r of I star is equal to b over 2, you have automatically a stable 2 cycle, okay? So it's remarkably simple. Question is it sufficiently robust? Well, first of all, let us try to understand the source of credit reversal. The fact that if you lend a lot in period t, you will lend less in period t plus 1. Why is that? Well, remember that investors sign 2-period contracts with bankers in this model, and the equilibrium condition implies that if they get a low return at date t, they must get a high return at date t plus 1. That's the equilibrium condition. And vice versa. If they get a low return, if they expect a low return at date t plus 1, then they will require a higher return at date t. So it's a very natural mechanism for credit reversals. The problem is that these credit reversals disappear if you introduce capital. That is, if you, in Meyerson's model, bankers have no capital. They have no, they don't have any endowments that they can add to the financing of the bank. It's only external financing. If you introduce internal financing, co-financing by the bankers and by the investors, it turns out that this credit reversal phenomenon disappears. So let me try and explain that. Suppose now that bankers, each banker has some endowment that he can use to finance the bank in conjunction with the rest of the people, the investors. So the banker has capital omega, and the investors, they finance the rest. So it's easy to see that the equilibrium condition in this case means that you can go a little further in terms of lending because of this self-financing capacity of the bank. But how far can you go? Well, in fact, the money that bankers put initially has to compensate exactly the losses that outside investors make. And basically, what are the losses they make? Well, they have to pay a bonus. And what they only get is the sum of the returns. And this with probability alpha multiplied by the size of the bank. So it determines a relation between the capital of the bank, which is omega, and the size of the bank, the capacity of banks to lend, and the multiplier, or it could be interpreted also as a capital ratio, the ratio of capital over assets. Depends on the returns, but on the 2 period, current period and future period. And again, here, it's a purely deterministic model. There is no uncertainty So why is it that the two cycles disappear? Well, simply because if you write down the same equation one period ahead, and if you want to have a two cycle, IT plus 2 equals IT, you realize that the two factors between brackets become equal, and therefore that the capital that each bank is allowed to invest is the same, but at two consecutive periods. So it implies that, in fact, we're on a steady state. So the only two cycles when you introduce bank capital are steady states. Okay? So the credit reversal phenomenon disappears. So I will now examine another route, and again I will try to compare it with the two previous ones, which is based on the notion of pecuniary externalities. So Hans Gersbach and me have developed recently a model where, by contrast with the Kiyotakian-Moore setup, you have fully anticipated and insurable aggregate shocks. And we have the feature that, indeed, at equilibrium, banks lend too much during booms and too little during recessions. And so why is it that the competitive equilibrium in our economy is constraint inefficient? It's because the banks do not internalize the impact of their investment decisions on asset prices, and they generate a pecuniary externality. Okay? So it turns out that this notion of pecuniary externalities are recently reappeared after it had been silent for many years, and now it has recently reappeared, and I will try to suggest that it's a robust feature of all the model, of all the different approaches that I've presented here. And so one way to restore efficiency is to impose a regulation that resembles what regulators in the real world have in mind, basically a sort of contracyclical lending limit. So let me try and explain the main feature of the model. And again, I'll try to make it as close as possible to the two previous ones. So here there is one factor of production, capital or land, if you like, which is in fixed total amount. There is one consumption good, like in the Kiyotakian-Moore model, 3 days. So it's only a static model in a sense that it would be important to extend it to more than 3 days. And there are two sectors. So the sector B is a sector where firms must be monitored by banks. And banks may also shirk on this monitoring activity, so there is more hazard. So the crucial thing would be what happens in the banking sector. In the other sector, sector F, firms can finance themselves directly on financial markets. There are no frictions, okay? So the important question is how much capital will be allocated to the banking sector, K, that's the aggregate amount of capital in the banking sector, or if you like, a measure of credit to the small firms, to the farms, let's say. And the other sector gets the rest. Of course, in a more sophisticated version, the total amount of capital would be, something happened? Okay. Would be flexible here. But here, let's take the simplest possible form, where the total amount of capital is 1, and then the only thing that has to be decided is how to allocate this capital between the banking sector and the other sector, which is financed directly by the financial markets. Okay? So the important point is that the return on assets in the banking sector for each bank is the product of two terms. One is an aggregate shock, an aggregate risk, Z, which can be high or low, correspond to a boom or a recession. So the source of the fluctuations of credit is real shocks. Contrarily to the previous models, we really have uncertainty here. And then there is also an idiosyncratic shock, which depends on the activity of the bankers, whether they shirk or they select and monitor their borrowers carefully. So the idiosyncratic shock can be can have also two values. It can be a success or a failure. And there will be diversification at the level of the economy. So on aggregate, the only thing that matters will be the aggregate shock. Okay? So now the question is, what timing why do we need 3 dates? But basically, the assumption we make is that at date 0, investors sign contracts with bankers. At date 1, the macro shock is observed, and a certain amount of capital is invested by each bank as a function of this shock, and it is specified ex ante in the contract. And then at date 2, the output is shared between investors and bankers. Okay? And so the important thing is that the rate of returns for investors have to be the same in the banking sector and in the financial sector, because the investors have the choice between financing the banks or financing the other firms. Okay? So when they decide to finance the bank, this is what they get. They commit ex ante to provide a certain amount of capital K of Z to the bank, or they allow the bank to lend the K of Z, because in fact they will only invest themselves K of Z minus omega, which is the self-financing part of the investment. And then you have the return on assets minus the bonus that you have to pay to the banker. Okay? So that's the cost of moral hazard, if you like. And what do we have on the other side? On the other side, you have the return that they would get on the same amount, K of Z minus omega, if they had invested it in the financial sector, where they will get a certain return, Q of Z, depending on the state of nature. So the important thing is that this is ex ante constraint, because there is commitment to provide financing, and in a way, it is related to the completeness of financial markets, which means that bankers and investors have the possibility to insure themselves against any form of shock. So the only source of inefficiency here is the moral hazard problem. There is no further friction related to the incompleteness of financial markets. Okay? So what do we obtain? Well, it's not very difficult to compute what is privately optimal. That is what each individual bank will choose. In particular, the decisions how much to lend to the economy as a function of the shock, K of Z. And in fact, as I said, bankers want to maximize the expected size of their bank because their bonus is proportional to that. But they are disciplined by the constraints that the financiers, the people who provide them the additional amount of money, they have to get the same return as they would get if they had invested in the other sector. Okay, so that's the... And so in equilibrium, the price of capital, again, like in the Kiyotaki-Moore model, satisfies the property that it's equal to the marginal productivity of capital in the other sector. So it's the same type of equation. And then how do we determine the aggregate amount of land or capital that is financed by the banks? Well, it's basically the adding up of all the individual constraints, because the model is, the banks are homothetic here. They all choose the same ratios. The size is proportional to the capital. So we have a sort of capital ratio that is imposed by the market. It's not a capital ratio that is imposed by a regulator. And then the aggregate level of capital is determined by this. So the important thing is that the competitive allocation, as usual, maximizes social surplus under these financing constraints, where the price of capital is taken as given. So basically, you maximize global output, expected output, which is here the measure of social surplus, and you take into account the aggregate financing constraints, which results from the property that investors must have the same return on capital if they invest in the two sectors. And then what you find is that a social planner would do something else. Why is that? Because the social planner would recognize that the price of capital is determined by the amount of capital that is invested in the banking sector. So in choosing K of Z, the central planner would take the price effect into account. Okay? And so you would get a different solution. In other words, the competitive equilibrium, even though financial markets are complete, the competitive equilibrium is not constraint efficient. And if regulation forces banks to lend less during booms, they will automatically adapt by lending more during recession. In a sense, it means that if you change this for Z equal H, they will adapt and they will lend more under recessions. And on total, this will increase expected output, and this will increase social welfare, okay? So again, the competitive equilibrium here is not constraint efficient because banks do not internalize the impact on their investment decisions on asset prices. And in fact, this pecuniary externality is very similar to the notion of asset fire sales that has been discussed in the literature. The fact that if all banks, all distressed banks are forced to sell assets at the same time, this will generate a deflationary spiral. But in fact, the phenomenon is symmetric. And for the same reason, if you're in a boom, you are going to invest too much, and the prices are going to go up too much. And so people have tried to explain that by resorting to some kind of irrational exuberance, or the fact that people forget or have a difficulty in evaluating risks during booms. But in fact, it could be just a result of this very simple pecuniary externality. So to wrap up and try to differentiate the three approaches in terms of policy implications, let me first of all discuss of the Kiyotaki-Moore approach. I believe that it's essentially a model of the credit multiplier, which is useful to explain the role of financial imperfections in the amplification and persistence of real shock. It's not really a model of credit cycle. Of course, you can have credit cycle if you add other elements, but it's more a model of the credit multiplier. Also, Krishnamurti has shown that if borrowers can insure their shocks, their wealth shocks, through contingent debt and financial derivatives, cycles disappear in the Kiyotaki and Moore model. So I believe that the Kiyotaki and Moore model applies more to small borrowers. It does not apply so well to banks, in order to explain the behavior of banks in terms of borrowing and lending, but it applies well to small borrowers, because small borrowers typically do not have access to those financial derivatives. They cannot pledge their future income, it's not easy, and their borrowing capacities is entirely determined by future resale value of assets. And there is a nice empirical work by Monacelli who shows the relation between real estate prices and household borrowing capacity. So for households and small firms, the Kiyotaki and Moore model gives a good representation of the impact of financial imperfections on credit and asset prices. But here, remember, we're talking of banks. We want to see how the capital of banks has an impact on their lending behavior. Okay, so it's a different story. We're talking of different objects of banks, and as argued by Meyerson, the borrowing capacity of banks is also largely determined by their expected future income. In Kiyotaki and Moore, your borrowing capacity is determined by your collateral. How much assets can you pledge? But in banks, I mean, it's true that for some activities like repos, collateral lending, collateral matters for banks. But for a large fraction of their activity, for lending to small and medium-sized firms, it's not so much the collateral that matters, but it's the equity that banks can put, the skin in the game that the bank have, okay? So if you introduce the notion that the borrowing capacity of the banks has to do with their future income, and not so much with the price of their assets, then you very easily get deterministic credit cycles. That is, equilibrium conditions imply negative autocorrelation of credit growth. But in the absence of real shocks, if you introduce bank capital in this model, you eliminate those deterministic cycles. But maybe deterministic cycles is more mathematical curiosity than a real economic thing here. What we want to explain is the sort of excessive fluctuations of credit due to real shocks. And this is what we have tried to do in this model with Gersbach, which in fact is an adaptation of the classical model of Armstrong and Tirol. And in this model, if you introduce real shocks, real productivity shocks in this Armstrong and Tirol model, we find that banks react too much to these real shocks. And there is excessive volatility of credit growth and asset prices. And in the absence of regulation, banks would tend to amplify real shocks. So there are no deterministic cycles in this framework, like in Kiyotaki, Moore, and Meyerson, but another interpretation of credit cycles, which is excessive reactions of bank lending to real shocks. Okay, so a counter-cyclical capital requirement is a useful regulatory tool because it limits welfare decreasing pecuniary externalities. And one important observation is that these externalities are also present in the Kiyotaki and Moore framework. And in fact, Jeanne and Korinek have a recent paper where they show the same type of result in a Kiyotaki and Moore framework. So in other words, maybe what we mean by credit cycle is not exactly what is relevant for practitioners, for regulators. And maybe the main reason for intervention for new forms of banking regulation, which is these externalities, maybe this is a robust feature of the different approaches which have different implications in other dimensions, but for this particular dimension, they all show that pecuniary externalities are present. Okay. So let me conclude by saying that the two papers by Bernanke and Gertler and later Kiyotaki and Moore have had a major influence in the development of more realistic macro models incorporating financial imperfections. And the main form of those financial imperfections is this collateral constraint. So this model has been very useful, I believe, for central banks in developing empirical models for simulating the impact of, for example, monetary policy decisions on the impact of this decision on credit and output. So those models are used by practitioners and especially by regulators. But now we're talking of a different regulatory question. We're not talking of monetary policy. We're talking of imposing new regulatory tools like counter-cyclical capital requirements. Of course, I forgot to say that capital requirements have been used for a long time for a different objective, which is the protection of depositors. And that's what is called the micro-prudential regulation of banks. This is more or less well understood. What is not clearly understood is the macro-prudential part. Why do we need to have, on top of the traditional instruments, these new counter-cyclical buffers? Well, maybe there is a possible answer to that, which is these price externalities that are common to the three different approaches to credit cycles that I have proposed here. The three different approaches lead to different conclusions, but there is one feature that they have in common, which is this pecuniary externality. And this one feature could be a way to answer the questions of the regulatory authorities and say, this is what you have to do. But of course, those models are very far from applications and for calibration. So I think, and that will be my conclusion, that there is a real need, and this is suggesting the interest of the PhD students. I mean, there is a crucial need for helping the development of new macro models with the financial sector, but where the imperfections are not only due to collateral constraint, which corresponds to what happens on the downstream credit market, but also on the upstream credit market, what determines the capacity of banks to attract funds to lend to the economy. So this particular aspect of the credit market has not been modeled satisfactorily, I believe, in macro models. And if we are to let new supervisory authorities, sort of experiment by taking decisions that have an impact on the lending capacity of banks and, of course, indirectly on output and employment, we better give them correct tools. So there is really a need for developing such models of financial imperfections. And that will be the end of my presentation. Thank you very much.
Thank you. The timing was amazing. And just let me ask if anybody has questions. Very good. So, Andrea, go ahead.
So my question is, it seems to me that in the models that you presented, there are two rather important assumptions, which is one played by the bonds of the banker, which is in some way a function of the asset of the bank or the size of the bank. And the other one is the capital ratio, which is a simple capital to asset ratio. Now, my impression is that the debate on the countercyclical capital buffer is partly related to the asset risk of the bank, meaning that the existing capital regulation is such that when you go into a recession, asset risk goes up, and therefore banks either want or are constrained to increase their capital requirement, and therefore their capacity to lend is constrained, and therefore they increase that. And if they all do the same during the recession, there's also the macro-prudential issue, because that might be sound at the micro level for the individual bank, but it's not at the system as a whole. So I wonder whether there's a missing piece in your models, which is the asset risk of the bank. Because it seems to me that it plays actually a crucial role in this cycle type of mechanism.
Okay, so you're absolutely right. In fact, it's the spirit of the regulation. If you talk to regulators, they have exactly this view that capital is a buffer against losses. But if you want to, and I don't think the two are inconsistent. In particular, you mentioned asset risk. Here, the objective is to prevent banks from making too risky decisions or for taking too much risk. And this has to do with the incentive mechanism. And so what you describe as assumptions, namely the bonus proportional to the size and capital requirement, are in fact predictions of the model. That is, they are the optimal way to provide incentive for the bankers to choose the right investment. So the two approaches are not inconsistent with each other. And the second one is allows to depart from the Modigliani and Miller paradigm, because every time you talk to an economist about bank capital, they tell you, but what's wrong? Why is it that we cannot apply Modigliani and Miller? Okay, so the reason why we cannot apply Modigliani and Miller is precisely the more hazard problem here. So I think the two approaches are compatible, but it's true that we have to convince regulators that the second approach, the incentive approach, may be more important than the pure asset buffer approach, because if the bank has good assets, even if it makes losses for reasons of bad luck, there is no reason why you wouldn't want to lend again to the bank in order to invest in good projects. So I believe that the incentive approach has to be incorporated into the philosophy of bank regulation.
And I have a paper in the IGIER, like maybe 12, 13 years ago, which has, I think, something close to your story, but simpler, which has, it has credit cycles and it's generated through a pecuniary externality. The idea is simpler than anything what we have, which is that if bankers have a lot of wealth, they demand a lot of capital, that pushes up interest rates, squeezes profits, the banker's wealth goes down as a result of that. That then feeds back onto their inability to borrow in the future, and you can have stable cycles, all kinds of stuff, coming out of just that mechanism. And it's exactly the pecuniary externality coming from the fact that nobody takes into account the fact that the price of capital hurts other bankers when they borrow. So
okay.
It has exactly this.
Sorry, I overlooked this paper. I will look at it, but I think it's perfectly consistent from your description. It's perfectly consistent with particularly the Meyerson's approach. So I will look at it. So, but here, no.
One period. What we have is a one-period contract, so there's no incentive problem.
No, sure, but yeah. Okay.
The model is, of course, very interesting, very fascinating to see how you drive implication on the asset values from the existing banks, right? And it would be interesting to complement it with a full-blown asset pricing model with agents that do interiorize the fact that banks are on the other side and they do influence the asset pricing. And so
I think people have done some of that already, and so there are papers doing that. But my intention was really to go to the fundamentals and to present the simplest possible story in 40 minutes. But what you say is absolutely right. I mean, this has an impact on the relative prices of financial assets, for example, and it is related to Brunner Peterson, but also Holmstrom and Tirol, the LAPM, for example, they call the LAPM, is exactly that, the pricing influenced by the liquidity of the assets and the possibility to be used as collateral. So,
in SCA model, which agents though, there are both agents that make portfolio allocation and banks.
yeah. No, you're absolutely right.
Alan?
I was going to ask about a broader set of policy instruments. In the U.S., after the financial crisis, or sort of long after the financial crisis, the President signed a small business bill, which did three things. One is it increased loan guarantees. So Small Business Administration charges, or now they subsidize with the price, to guarantee losses to loans to small businesses paid by banks. Second, which was innovative, and it was my idea, so I like it, is we created a $30 billion fund where we would invest capital in banks, had a 5% interest rate. The banks increased their lending to small businesses, very broadly defined. We reduced the interest rate to 1%. If they reduced their small business lending, they actually raised the interest rate to 7%. Then the third idea, which I wasn't a particular fan of, is to give money to states so that they can kind of provide backup for collateral. So the state of Michigan has a big program where they kind of pick some companies and they say you're having trouble borrowing because your collateral value went down. Well, you know, if you go bust, you can count on us to kind of guarantee your collateral. I'm curious how you evaluate those three different alternatives. It would seem to me complementary to the idea of capital.
Absolutely, and there are even other instruments that are being considered. The notion of a stability fund, where banks would pay premium in order to receive capital in case they need it, or the notion of systemic tax, where you would try to measure the externality imposed by banks' decisions on other banks, and you would like to tax them. But my general reaction vis-a-vis this kind of policy, especially the ones that involve the government or the politicians, is that it can very easily lead to all kinds of political economy issues, and I don't think that it's a good idea. I mean, you want to have, the ideal world, I would like to have the regulator really separated from political influence and from lobbying by firms. So it would mean that you would give the least possible powers to governments, to local governments, or you would like to do that on an independent basis. But of course, it's difficult to do in practice. But I agree with you that there are many other instruments that could be useful. But the question is, should this instrument be used exceptionally in periods of crisis, or should they be used systematically? I don't know. That's another issue.
This is asking again Andrea's question another way. If you take net present value knowledge price assets, there are two main drivers of the asset prices. One is the discount rate, which is still a discount rate, and the other is the dividend curve. Now, if you consider the recent presidential address by John Cochrane at the IAFA, he pointed out that the empirical evidence is very strongly in favor of the relation between asset prices and future discount rates rather than asset prices and future dividend growth. This evidence would put, I think, a totally different transmission mechanism.
That's right.
Which is probably the one underlined by Andrea. I wonder how you see it.
No, I think that you're absolutely right. There are other drivers of fluctuations, and the reason I focus on this particular driver was because I wanted to answer the precise question of what bank regulators can do. Because I believe that the way to act on the kind of transmission mechanism that you have in mind is different tools. You can use monetary policy, you can use fiscal policy, and these are controlled by other institutions than banking regulation. So I was really focused on the particular set of instruments that are available to the bank regulators, and this is why I focus on this particular. But what you say is absolutely fundamental. There are so many different aspects of financial stability and stability in general, and there are different actors who can or cannot contribute to stabilizing the economy. Particularly budgetary policies is a clear element that is outside the scope of my presentation, but which is fundamental. So you're absolutely right. It's just the focus that I chose to give to my presentation that suggests that.
Yeah, I have a question about the issue of rules and regulation, which goes back to the spirit of Alan's question. I don't understand anything about financial markets, but in the context of monetary policy, we have this debate about rule versus discretion, and something which I've talked about this afternoon, that if a rule is very complicated, monetary and fiscal policy, if a rule is very complicated, then it becomes very difficult to enforce, and there are all sorts of rules for gaming. I never hear this argument made about, or much less about bank regulation. I mean, we talk about cyclical requirements and risk-adjusted things and all this stuff that sounds like you can do just about anything you want. I never hear this argument about simplicity of rules, which is very problematic. When you talk about fiscal policy, something as simple as a cyclically adjusted balanced budget will already make my ear sort of worried, because how do we agree with the correct adjustment? And that relates me to the other point you made, and bypassing that, the regulators have to be not captured and this and that, it's easier said than done. So I see very little of these two issues in the practical debate on regulation. So, what do you think about that?
With immodesty, I will send you the book we wrote with Tirol and the VAT report, where we have a chapter on that. And we explained that one of the reasons for the poor performance of Basel II was precisely that it was way too complicated, and that it was impossible to check that the regulators were doing their jobs, because the things could be manipulated. So I fully agree with you that simplicity is a major element of regulations. So now the question is, how do you implement in a simple way a countercyclical buffer? That's a real issue. Some people have proposed complicated formulas where you would have some measure of credit growth of a GDP or this kind of things, and you would use different indicators in order to automatically force banks to hold more or less capital according to the business cycle. I think that is perfectly ridiculous to do that. I think what is the only possible ways is to give some discretion to a small group of people, independent experts, very much in the same way that you have monetary policy committees, where you have people who have different opinions on the state of the economy and the relevance of increasing or decreasing interest rates, and they use that. They use simple models which are not totally kosher from a theoretical point of view, but which are useful in practice, and they vote. And I believe that this mechanism is very imperfect, but it's much better than anything else. And what I have in mind is a similar mechanism for macroprudential stability, where you would use those countercyclical buffers only exceptionally, and you would have to require the vote of a financial stability committee that would base its decisions on opinions and on simulation given by the macro models I was alluding to. So I believe this is more an art than a science. It's something that you have to delegate the decision, because you cannot use automatic stabilizers. Automated stabilizer would not work. You cannot give the decision power to the government. You have to have an independent regulator, but this independent regulator cannot have a very complex mandate. He must have a very simple objective, and the example of monetary policy is ideal in that you have an inflation target and you have a simple instrument. Of course, for financial stability, it's more complicated, because you don't have a simple target yet, and you have many instruments, and moreover, there are many other people who control other instruments. You have the fiscal policy, you have the monetary policy, so the problem is much more difficult. But I believe it can be solved, I hope. it's not.
incentives are not well aligned and there are inefficiencies. So, with first order approximation, you could see these are two alternative stories.
Okay, so.
So if you grant me this, but then how do we tell these two stories apart? Maybe empirically. And the second question is, suppose we go for state contingent capital requirements. So would this type of policy tool be robust to these two alternative stories if they are alternative? So that's
okay. So again, I focused on one particular aspect, which is macroprudential thing. It doesn't mean I don't believe in the need to have capital requirements for other things, for precisely the thing you mentioned, the expectation of being bailed out and these kind of things. So the two things have to be put in the same picture. And in particular, capital requirement can be used both for this kind of moral hazard and for internalizing externalities. And this is exactly what we are going to have in Europe, for example, where you have the Basel III decisions to implement, certain improvement in the microprudential ratios, and then possibility for either the European Systemic Risk Council or for the European Commission to add on that an additional capital ratio. And then the question is, who should take this decision and based on what? And some people consider that there is a risk that the two instruments might be sort of mingled. And in particular, there was in the, I don't want to go into the detail, but this was this Pillar 2 type of approach for Basel II, which was the idea that there should be discretion by the supervisors in order to increase or decrease banking capital requirements as a function of their observation. If on top of that, you add another institution who also has the discretion to require more capital, you could have a conflict between those two institutions. So this poses real problem in terms of institution design. Who should control capital requirements? Is it the domestic supervisors in the case of Europe, or is it the European Commission or the European Systemic Risk Council? That's a very tricky issue as well. But I must make it clear that the real model would comprise exactly what you said, that you would have to incorporate also moral hazard in a classical form.
Well, time for the last question.
Jean-Charles, you said that in all the literature, the common point is that externalities. So, and you say that all the literature, almost all the models, face this problem using regulation, and that's all. I'm wondering if you can also use optimal taxation theory. Is there any space to do this comparison between optimal regulation and optimal taxation in this field?
It's a very good question, and actually it has been discussed already. People have proposed to introduce this kind of systemic risk tax. But the problem is who would control this tax, and who would get the revenue from this tax, and who would redistribute the revenue from this tax. So there is a clear political economy problem or institutional problem, because it's very likely that the governments would not want somebody else to control to have taxation power, especially if governments are domestic and the regulator is supranational, right? So I believe that it's, in principle, a very good idea, but in practice, it creates very big institutional difficulties.
Okay. Very good. So,
thank you very much.